Hi, everybody. Mike Sorrentino here, along with Bepin. Thank you for taking the time to listen in today. And it has been a doozy of a week so far. Um, if you're listening to this right by now, you probably see a lot of red or have seen a lot of red on your screen. The announcement of tariffs across the board from the U.S. and presidential administration has been quite dramatic. And,
Yeah.
I think Bepin, given the tantrums of the past, right? Do you remember the taper tantrum?
Yeah.
That was a great one. Back at this point, God, 12 years ago, I think maybe at this point, where markets freaked out because Ben Bernanke said one wrong word at the wrong time and everything went crazy. So we felt it was appropriate today to call this the tariff tantrum, simply because of the reaction that we're seeing right now in markets. And we don't want to downplay the impact of tariffs too much, but I think it's a little bit. I think it's important to kind of dig a little bit deeper to ask ourselves, from a truly objective point of view, what are the implications? And to do that, we're going to have to do a very, very difficult thing, Beth, and we're going to have to take our political views, our emotions, and all of that, whether you agree with terrorists or you don't. Push all of that aside. You got to push it aside, right? Say
That's the
that
prerequisite to this
that is the
presentation.
prerequisite.
Leave those at the
Say
door before you move forward.
those are great for cocktail parties, okay? But we're not drinking cocktails right now. We're talking about really important stuff.
Not
So
yet.
that being said, I think it's important also to have some historical context. Now, maybe some of us don't remember what 2018 was like. 2018 was riddled, just absolutely riddled with tariff talk, tariff headlines, tariffs being imposed, retaliatory tariffs. This went on for the bulk of the year, and frankly, through the end of Trump's administration in many ways, shape, and form. So, to quote a very famous quote, probably one of the most famous quotes from any president of all time, the only thing we had to fear is fear itself. I think this is a testament to what's going on in the markets right now. So many times we've seen this where the volatility itself in markets is not what causes quote unquote risk to an investor. It's how we react to that volatility, which is often the problem. So if we think about it, again, go back to 2018. It was a time that I think most of us probably don't remember all that well. We've had a lot of really weird things happen in those 7 years, right? In terms of our country. And if we can kind of spend some time and remember that how many headlines and how much talk there was about tariffs in 2018, tariffs on China, tariffs on the EU, retaliatory tariffs. Does this sound familiar to Bepin? Because it sounds to me
Yeah.
like what we're hearing right now, almost the exact same thing. Now, I'll first admit that the tariffs announced this week are larger in scale than what we heard about in 2018. There's no question about that. Okay? But ultimately, I think human behavior doesn't change all that much over time. And if we go back to 2018 and through the end of, I think, 2019, so call it a 2-year time frame.
Yep.
If I invested, and this is a great chart, if I invested $10,000 at the beginning of the tariff freak out in 2018, and I just ignored that volatility we saw in the first quarter of the year, and it was, if you remember, it was an extremely volatile time period. And then the tariffs got announced, I believe it was in March of that year. And then it just kind of, people calmed down, they relaxed, they said, okay, we finally got it out there. And then kind of markets took off from there. And then we had some Fed problems towards the end of the year. But my point here is that $10,000 investment there, at the end of that period, was worth about 12,500. Call it a 25% increase. I don't know the exact number on this chart, but it's somewhere around there. Okay. So again, if you could have ignored all the banter, all the chatter, all the talk, all the headlines, all the stuff that's going on right now, if we could just ignore it, because the tariffs fundamentally, yes, they are going to impact the economy. Yes, they're going to impact companies in the United States and outside of the United States, but they are not going to send the economy into a recession. It doesn't work like that. So we've got a historical context to say there's a very high likelihood that the markets will absorb this information and move on. Now, we're constantly bombarded with the other concern, and that concern is inflation. Well, if we increase the price by 25%, something coming from Canada or Mexico or wherever it might be, or any part of the world where it might even be higher than that, well, the price of that good's going to go up, and therefore it's inflationary. And look, yes, prices on certain goods are going to go up, particularly if there's no obvious substitute for that product, right? So there's a component of that as well. But widespread inflation, we just haven't seen it. Like if you, again, look at this chart, it's the orange line. It ebbed and flowed throughout that same time period, but ultimately at the end of the day, it didn't really move all that much. So we could have the conversation about inflation. We'll talk a little bit more about it as we go along here, but ultimately, I don't want to say the tariffs were a non-issue back then because it certainly does impact certain companies and whatnot on a micro level. But on a macro level, it was a story that kind of came and went. And I feel like we're seeing another version of that right now. So the question is this time different? I don't think it is. I mean, I would say if anything, Bepin, feel free to debate me, but I feel like the US in 2018 relative to today, look, the US was the 800-pound gorilla in 2018. Today, they're probably like the 2,500-pound gorilla.
Yeah.
And we've gotten
even
bigger and we've gotten so much bigger in those 7 years with everything that went on even then. We are the Costco for every retailer that Costco brings into the warehouse. What I mean by that is typically anybody that sells in Costco, any company that sells in Costco, usually Costco is their largest customer by far. Like it's not even close. So when Costco says, I want to do something, they might not like it, but what are you going to do about it? And I don't want to, again, I don't want to sound cavalier about the situation, but it's kind of true. Look at this chart. If you look at exports as a share of GDP, think about how tariffs impact different countries. We talked about this in prior webinars about how Canada and Mexico are far more susceptible to tariffs than we are. As you can see at the very bottom here, the United States, 11% of our economy effectively are exports. Okay, it's not that much now compared to some of our other larger trading partners. Canada is a third of their economy, Mexico just a bit higher than that, Germany close to half of their economy is exports. So when I think about tit for tat or retaliation or whatever you want to call it, the US is in a very, very good spot for negotiations going forward. Like I can't think of a single country that's on par with it's even close to the US, with slight exception to China. When I say about China is that they just got a more diversified range of customers relative to some of these other countries. But ultimately, we've got the cards. It's that simple. But let's be real. Prices are going to go up on some items. They just are, right? Tariffs, they got instituted this week and they're effective immediately. So I do think that there are going to be some instances where, and I know obviously with the audience on the call today or the webinar today, cars are a big deal. So we could certainly see prices come up.
I'd like to remind everyone that the USMCA goods are still at zero for the time being. So if there's any panic around the auto industry, stay firm for a little bit there. We still don't have full clarity there on what the final sticking tariffs are going to be on cars.
Yeah, that's a very, very good point. And honestly, and again, Bepin and I are not crazy enough to bet on the future decision of a government policy. But it would be very surprising if the auto industry here was as impacted as some of the fear mongering that's going out there is saying right now. Okay, so again, we don't want to make a call on that, but it would be very shocking from a political perspective if they went down that path. But look, like I said, there are going to be certain things where, again, if there's not a substitute available, it's a very simple example. If bleach is being imported into the US and is being made in the US and the bleach goes up by 25%, well, there's a substitute, a very easy substitute. So the economic impact of that situation is going to be minimal, at least for the US and for US consumers. There are going to be other instances where, it's probably not going to be that easy to find a substitute. And that's where we're going to find some issues, I think, with prices going up. But again, I want to be abundantly clear about something. Prices going up on individual goods is not the same as watching inflation destroy a currency. Okay, the inflation around currencies and the inflation that what everybody's worried about in terms of what we saw back in 2022, that happens when you print too much money. It is that simple.
And speaking of tariffs and in terms of like revenue services, one of the big talking points that we've really been seeing from the administration is this idea of an external revenue service, which would be from revenue from the tariffs, hopefully offsetting some of the deficit, potentially even taxes. This is taking a look at tariff revenue that we've seen since the 2018, or even earlier than that, but just kind of to show the trend. Since the 2018 China tariffs and steel tariffs on the EU and Japan and whatnot came around. And as you'll see in the 2018 tariffs, if you look at 2019 onwards, you see a big jump there. It goes from about 40 billion, 30 some billion to 70 billion, almost 2x's. And then COVID happens, it dips a little bit. We come out of COVID, it goes up, and the trend continues going up. And eventually manufacturers begin to adjust. Now, like Mike said, these are different tariffs. When we were talking last time, it was China, and then yes, there were a little bit of tariffs put on steel from the EU, Japan, and some other trading partners. But this time around, obviously, it's far more broad sweeping. So, well, you could really get the point here would be that, well, companies really begin to move operations to places that don't get hit by tariffs. And as it sits right now, there are many places that are avoiding the tariff hammer. But that isn't, we don't believe that's the final goal. We believe that countries will likely rush to the table to try to make some sort of deals. The rule of thumb with deal making is the first to the table typically gets the best deals. The ones that come in later down the road, they get what's left. So there is a high incentive to come and try to make a deal. And as they do become one of the first countries that are non-tariffed, who do you think is going to get all the kind of like the third party business where people leave from China, Mexico, or wherever is still getting hit with tariffs and finds a new place to operate that isn't being tariffed? So there are high incentives for these countries to play ball. Now, will they all come sweeping in all at once? We don't know. But we wouldn't be surprised, like Mike said, if you're listening to this call, there could already be some updates, some discussions about negotiations and how they've been going. But that's just a matter of wait and see. The only person that really has an answer to that is sitting in the White House, so we can't really make much commentary there. But if you do see some deals start getting made, this is where we would really see country or companies begin to reallocate resources to those places to avoid the tariffs for the most part. You'll definitely still see some coming to America as well, but at the end of the day, there still is a need for some cheap labor in some lines of business. Like t-shirts don't work in America. They just don't. And if they do, it's going to be with robots. And I don't know if that's really manufacturing jobs, So we're looking to employ people. So chips, pharma, that all makes sense. And that's all above board. But then when we get to the t-shirts, when we get to the cheap consumer goods, I don't think we have the stomach to pay 2 to 3x. So I think we'll always need some sort of cheap labor somewhere. And as Mike was pointing, that we have a lot of leverage economically, but let's keep in mind that the stock market isn't the economy. 40 to 50 or 50 to 60% of people work for small to medium-sized businesses. The rest work for S&P 500, the large companies. And as you get larger, eventually you have to start looking for business overseas. And the chart you're looking at right now is showing the share of sales derived from outside the US across various different indexes. Starting left to right, you got the Russell 2000, a small cap index, about 21% of the revenues derived from overseas. Then you got the mid cap index at 25. You got the S&P 493, basically the S&P 500, just minus the biggest seven. Then you got the S&P 500 with all that included at 28%, the NASDAQ at 46%, and then the Magnificent Seven. You got that at 50% almost of their sales are derived from outside the US. Obviously, some of the largest international businesses we have, so they're going to be some of the most exposed, and you've seen it. If you follow the stock market, you follow individual names, you've seen that the Mag 7 and a case by case basis is down anywhere from 25 to 50% year to date, or off of highs. But the rest of the market should hold up much better. And that's been kind of the push that we've been discussing over the last few calls, where I know you guys have known that we've added to our small cap position. Obviously, that's been down, but it was part of the idea that the America First deregulation, less exposure to international trade, that's part of the thesis there. And if we can get past this initial shock of the tariffs, those are the companies that we believe will be the most isolated from this. Now, that's another reason why we've been moving a little bit more towards value, and we've diversified outside of the US as well. If you look at some of the international indexes, they're up on the year. So when you look at the stock market, the U.S. stock market down, don't think that that's what you're 100% invested in, but if these stick, we would expect them to lower earnings on the year for the largest companies in America. But again, we still believe that these are negotiation tools, that they're getting other countries to the table to make trade better for the whole world, not just us. But then you're probably thinking to yourself right now, you're like, well, Bepin, if you're telling me that stocks could go down if these stick, and as of right now, they look like they're sticking, why wouldn't we sell? Why are we not selling the S&P 500? Why aren't we selling our U.S. equities? And the reason being is because of this next chart, which is showing that you just can't time these things. And especially a situation like this, where not to be a little bit hyperbolic here, but this could all change in a tweet. This could all change in one 60-character message, where it's a decision of like, oh, spoke to reps at EU, looks like a deal's coming on the table, market's up 10-15%. And what you're looking at here is the value of 10,000 invested between 1995 to 2024. And it's showing you the effects of missing the best days. Looking at the top there, if you were invested fully the whole time, didn't look, didn't sell, didn't do anything, you would be up 224,000, almost 225,000, let's just say. You miss the best 10 days, you're at 10, or you're at 100,000, a little bit less than 50% of the return, just missing the 10 best days. And I promise you, the day that a deal is announced will be one of the 10 best days in this year. I can almost guarantee it, unless it's the day right after that too. Just because of that, that's where all the volatility, that's what everyone's watching right now, is trade policy. And if there's a positive update in terms of deals coming to the table, where not only are the tariffs we just put on going away, but the tariffs they had on us are also coming down or going away entirely as well, I would not want to be short the market on that day or not be invested during that time. And we understand these are scary times. Obviously, you see the market, I think as of today, or as of right now, we're recording this Thursday afternoon. S&P's down about 4, the Nasdaq's about 4.25. So these are big days. I wouldn't be surprised if there's a markets in turmoil session soon on CNBC. And again, you guys know our opinion. I know exactly. You know our opinion on the markets in turmoil. I know Matt and Steve have talked about that a few times on their podcast. But if you see that and you have some money under the mattress, you give us a call immediately, because those are by far the best days to be getting into the market. And these are the times that we'd like to take a step back. And as Mike's been talking about, as we've been talking about in numerous presentations, is to look at it in the long term. These tariffs, in our view, are not here for the long term, but we believe the things we're going to get on the other side, once deals do get made, those are the tailwinds that are going to carry us into the new industrial, healthcare, financial revolution, really just getting everything moving forward and back to business in America for the most part, and that's the hope, is to clean up some of these barriers that we have.
Yeah, Bepin, this is without question one of my favorite charts that we could show, because I think it's not just representative of what happens if you miss 10 best days. I think the second order or second level question here is why? How could 10 days make such an impact? And I think if you kind of peel back the layers of the onion, you start thinking about, well, when are the best days in the market occurring? Like the massive run-ups, okay?
Mm-hmm.
When do those happen?
The day after the worst day.
Exactly.
Yep.
Right? They happen right around the bad days. So, so the thing is if you're going to sit there try to get cute and try to trade through something like this because there's a lot of bad volatility in the market, you're going to miss the good volatility. And we know simple math. If something goes down 10% and it rises 10%, you're not back at even. Okay? So this is the psychology behind a chart like this is incredibly powerful. And I know it's not easy. I don't like stock. Look, I think Bepin and I are the first to admit, like, it would be great if the market was up 5% today, but it's not. Okay. But ultimately, what we don't want to do is we don't want to get cute and try to trade through something like this, because if you make one or two simple mistakes, which is probably going to happen, to be blunt, it's probably going to happen because nobody has a crystal ball. You do that, you change your financial future forever for no reason. That's why this chart is so powerful.
And with that, we would like to thank you for tuning in. We know that these are unsettling times, and if you ever need to talk and ever want to talk to your advisor, have any questions for us, you feel free to reach out to us at any time. Thank you and have a great rest of your week.